Hello and welcome to the World Built Environment Forum webinar series. Today's session is in partnership with Deepki, and we'll be discussing carbon accounting, particularly in the context of construction, real estate, legal compliance, and ESG reporting. My name is Fabrizio Varriale. I'm an analyst at RICS, and we have three excellent panelists with us today. We have Emmanuel Blanchet from Deepki. Hi, Emmanuel. Would you like to introduce yourself?
Hi everyone. I'm Emmanuel Blanchet, co-founder of Deepki. And at Deepki, we are the leader in Europe to help real estate players achieving a net zero pathway with collecting data, helping in all the regulatory reporting, and of course, helping them to design investment plan to achieve a net zero pathway.
Thank you. We have Debbie Hobbs from CBRE. Hi, Debbie.
Hi everyone, I'm Debbie Hobbs. I'm a carbon and net zero carbon sustainability director at CBRE, and I'm working 100% with S&P Global as a global tenant at the moment. And I previously worked landlord side, consultant side, and seeing the industry from quite a few angles. Thank you.
Thanks, Debbie. And Mark Roger from Turner & Townsend. Hi, Mark.
Hi everyone, I'm Mark Rogers. I'm a director at Turner & Townsend and also head of net zero carbon for the cost management team here in the UK. So my role over the last couple of years has been really developing our net zero proposition for clients in the cost management area and also developing our whole life carbon measurement tools as well.
Thank you, and thank you very much for joining us here today. Just before we start our discussion, I want to tell the audience to feel free to submit questions to our panel, as it really helps to bring the conversation to life. Now, if you're new to these webinars, you should see that you can submit questions at any time using the question box on your screen. We will pick up as many as we can as we go through the session. And now let's start with the questions we have prepared for our panel. Since we are discussing carbon accounting, it might be good to begin by talking about what is carbon accounting. I mean, beyond the basic fact that it is the measurement of carbon emissions associated with specific economic activities, but how is it measured? What are the methods? Emmanuel, would you like to start?
Yes, thank you. Let's start with the start. But of course, we are talking a lot of carbon accounting, and this is the purpose of this webinar. But yes, today, maybe sometime we are not talking about the same thing when we talk about carbon accounting, and that's why we need some clarity, and I'm sure that it will be the case in the coming months and years. When we say that we measure carbon, one really important question is why we are measuring carbon, and maybe we will talk about that a little bit, is clearly, depending on the objective, you won't use the same methodology. And so far, the carbon accounting was more for corporate to have, I would say, a first idea about their responsibility and what we call direct and indirect emissions. But then more and more, the regulation is a financial regulation on carbon accounting, which means that sometimes what we used to call scope 1, 2, and 3 can be a little bit different regarding the objective. I can take an example in the real estate industry, which is really pregnant. Is clearly that, for example, if you are a corporate and you want to take into account what is really carbon accounting for your company, it won't be the same question or the same methodology that you will use if you want to, for example, assess carbon accounting for your product as an investor or as a real estate fund. And that's why it's really key to maybe share in the real estate industry some principles, and we are talking about frameworks and standards, but even in the GHG protocol, which is mainly the main standard applied today, we can count different type of carbon in the same way of counting. That's why it's really important, and I'm really happy to participate to this webinar. I'm sure that this will be, I would say, we try to bring some clarity about what we want to account.
Thanks, Emmanuel. Debbie or Mark, would you like to add anything? No, then I might move on to.
Mark. I agree with what Emmanuel said. Really, I think carbon accounting is a funny term because I haven't heard it very often. People talk about measuring carbon, they talk about reporting carbon, and I think one of the problems around sustainability in general is there's too many acronyms. So hopefully today we'll demystify everything a bit and have some good discussions here about what we mean and where we're going.
Sure, we will. Don't know if Mark, you want to add anything, otherwise I might move on to the...
No, I was going to say, I think it is really around trying to get that consistency, isn't it, and terminology, and making sure we're obviously all trying to aim to achieve the same thing, but we're doing it in the same consistent way and being able to report and compare in the same way. I think that's the key thing that we've got to try and achieve.
I agree. So Debbie, if I might pick up on something Emmanuel started, which is essentially, Emmanuel, sir.
No, sorry. It's just maybe to add something on that one is like carbon accounting used to be something to have a first assessment, and that's why mainly for corporate it's like spend-based methodology, which means that you are taking a look at your activities and you convert that to CO2 emission. More and more, we are really talking about achieving a net zero pathway, and it is not anymore assessment and reporting, but more action and savings. And in that case, we have to switch from an assessment to a real action, and sometimes spend base is not really enough and limited to such an objective. So we need to professionalize the way we will count on activities. That's why it's really, again, maybe it's a good news also, that professionalization of carbon accounting, because we are switching from a world where it was reporting assessment to a world where the purpose is really to achieve net zero and to point out real savings on carbon emissions.
Thanks, Emmanuel. Yeah, that leads me to the next question, which is actually why are we asking companies effectively to spend their resources to undertake this activity? So Debbie, if I might ask you.
Yeah, sure. So I'll try and be brief because it's something you could talk about. I'm conscious forever, but I think there's two main reasons why companies are measuring and reporting their carbon. The first one is a growing a sort of plethora of legal compliance. So there's a number of legislative compliance areas around the world emerging. I'm currently chairing the office sector group for the UK Net Zero Carbon Standard. So this is another standard that will ask buildings to report carbon in a certain way in order to be certified net zero, and that's still all got ongoing. But there's lots of legal compliance, particularly in the UK. We've got the SECR, the Simplified Energy and Carbon Reporting. We've also got ESOS, which came from an EU directive. In countries in Europe, we've got the equivalent EU directive, the Energy Efficiency Directive, which requires companies to report their carbon within that country if they meet certain threshold limits. It has to go in those companies' annual report and accounts. And the minute it goes in the annual report and accounts, you're into all the scrutiny of accounting systems. So you've got all the big four auditors auditing all your figures and numbers. And, you know, I think at S&P, we get audited at least 4 times, two internal and 2 external audits for every greenhouse gas footprint we produce. So there's a growing amount of legal compliance, and then there's what I call voluntary compliance. So most corporate companies for a long time have set their own targets on carbon and energy, and it might be that they've committed to be net zero by 2030, like S&P have, or 2040. They might have committed to be zero water and whatever, but all those numbers have to have a very regimented process by which they are accumulated and measured. And as Emmanuel said, to date, most people have all used the greenhouse gas protocol. So all carbon footprints are done using the greenhouse gas protocol for corporate companies. That allows you to define your boundary, allows you to find your scope, your method of reporting, be it financial or operational control. And it does mean that there can be an overlap. So just to check, scope 1 is direct emissions that are burnt and created on site, such as fossil fuels and refrigerants. Scope 2 is indirect, normally electricity for most companies, and those are belonging to that company. Scope 3 tends to be supply chain, but somebody's scope 1 and 2 in the real estate sector could be somebody else's scope 2 as well, and that's particularly true of tenants. So people like GRESB and all the accounting systems of more voluntary accounting asked landlords to use tenants' energy as scope 2 and take control of it. But then tenants say that the electricity they use is their scope 2. So there's a lot of double accounting there as well that goes on. And it's down to the organisation to explain how they're doing that in their footprint at the moment. And I guess the final thing to say is, as we move forward into individual buildings, net zero carbon certification around the world, so far every system I know is doing that slightly different. So are you encountering refrigerants? What evidence do you need of refrigerant top-ups? Are you using on-site, off-site renewables? What certification do you need? And all this is growing. You know, we're only at the beginning really, because we've got the EU taxonomy coming in. The US have got their SEC legislation potentially coming in, which will mean companies have to report more and more. And although we can't avoid it, it's not actually achieving very much. You know, it's not meaning, none of this legislation actually means somebody has to reduce their carbon, it just means they've got to report it. And to give you an idea for S&P, there are four trading companies with a UK arm, limited companies. So for the simplified, and I'll go back to that in a minute, energy and carbon reporting scheme in the UK, I have to use 3 floors of a building in Ropemaker and divide it into 4 different companies and produce all the figures every year to put in their annual report and accounts, which takes a huge amount of cost and time for S&P, but doesn't help at all to save carbon. Just meaningless numbers that nobody understands that go, and this is going to grow and grow and grow. The only real meaning one is in the real estate sector is buildings getting certified to net zero, whether it's a neighbours rating or whatever. So, sorry, I'm going to stop now because that was a very long answer, but it's going to grow.
Thanks, Debbie. Mark or Emmanuel, would you like to expand on that?
Well, I think Debbie's answered it really well, to be honest with you there. I think the key point that Debbie's making as well, from what I take away from that, is that it's obviously a tool to help understand where you are, but it's not the, you know, you have to actually do something to reduce your emissions. It's not just saying this is our number. Look at where we are. It's like, well, how are you going to achieve net zero? So what's your actual strategy and your roadmap? You know, have you changed your operating model, and what's your delivery plan to get to net zero? So I think it plays a really key part, but there's got to be a much wider sort of strategy in place to actually achieve where you're looking to get to your net, so you know, your net zero 2030 goals or whatever there might be. So I think it's actually the plan that's the important thing to help try and drive down the numbers in the first place.
Thanks. Emmanuel?
Yes, just one point. Of course, Debbie and Mark are totally right. And the fact that the regulation is really a key driver. But then maybe in the real estate industry, that it is maybe the first activity where there is an alignment between the carbon assessment and the economic activities and the business. And that's maybe a good news for real estate. What I have in mind is the fact that, of course, regulation and compliance is a key driver today. But then you may notice that it's the first time in the history where the performance of the building have an impact on the value. And this is key, because now, even if you consider that for an asset manager, the tenant's consumption is in scope 3 or in scope 2, I don't care, because you have to assess the total performance of your building, because it's a financial risk for you. In 5 years, if your building is a low performer, you will have challenge either to invest to achieve your net zero pathway, or you will have a decrease or maybe a risk to rent it or to sell it. So that's something really interesting in what we are discussing today, is like carbon assessment is now assessing a financial risk for real estate players. And this is key. And again, scope 1 and 2 and 3, that's really interesting. It used to be something for corporate to like take a look at, is it far or not far from my responsibility? Today in real estate, I don't care. It's a really maybe an issue in terms of reporting. So for GRESB assessment, I will put the tenant consumption in scope 3. For my SFDR reporting, depending on the company, you can put in scope 3 or scope 2. I don't care. But at the end, it is the total performance of the building that will be the key driver for the financial risk. So That's, again, I'm quite optimistic in that, but it's a good news for the market, because it's now not only a question of methodology and where I put my emission. It's clear that the CO2 emission is a key driver for my business.
Thanks, Emmanuel. Picking up on a previous point, maybe I'll ask Mark to expand a little bit on how can carbon accounting help, take action, as we're saying. It's the first step, but then you need to take action. How do you build on the carbon account or your measurement of carbon and the fact that you're reporting in to actually make the improvements or plan the improvements, as you said, particularly in the context of construction?
Yeah, I think the key thing, as I said before, is really having that strategy that's defined for either your construction project or your business, isn't it? You've got to really understand what the goal is and what you're trying to achieve. I think carbon accounting does play a key part in that. You do need to understand what the art of the possible is by knowing where you start from and knowing where you focus your energy on. By if you look at your scope 1, 2, and 3 emissions, where do you want to actually achieve the most reduction, and how can you do that with the greatest impact? So that all then helps to set that roadmap in place. But having that real action plan that's measurable, so you can see the improvement over time and what the impact is by measuring it and accounting carbon year on year is really important. The operating models can be sort of all geared around that roadmap and your delivery plans. But I think it also, carbon accounting can also help with setting policy direction. I think if there's that clear link in understanding what the benefit of changing policy is, and I think you can use that to help get employees engaged with the decisions that you make as a business. So you can see the impact of doing X policy has a clear benefit in terms of your carbon emissions. So rather than just being told what to do, you're seeing the why you're doing it and the impact of why you're doing it. I think that's really important to change people's mindset and behaviours. And then I think if you move down actually into the supply chain, and maybe if you look into the construction industry a little bit on this one, I think carbon accounting can help with provide that visibility of how products or services perform. Really shine a bit of a spotlight on where things need to improve and incentivize the supply chain to get much more climate friendly product, and it can help with decision making. So you can choose between product A or B or service A and B depending on the emission performance, the sustainability performance of something. And if you look at the spend on ethical consumerism in the UK over the last, I think 10 or so years, it's more than doubled. So people are spending the money on what they see as ethical or sustainable based on the performance of a product. So I think really that carbon accounting can provide that transparency, and I think it's always going to help. But I think if you look at again the corporates, when they provide their figures, I think they're always want to be competing against their peers in industry by showing how much they have improved or where they're moving towards their targets. So again, I think it can be used in that way to help drive sort of that bit of competitive edge between people.
Thanks, Mark. Debbie or Emmanuel, if you want to.
Yeah, I mean, I think, the fundamental thing is you can't manage something you're not measuring. So the first step is to get your footprint in carbon and then work out how you're setting your targets. Most corporates use the Science-Based Target Initiative. I won't go into the pros and cons of that, but that is the target that most people are looking towards, a sort of 90% reduction by whatever date they want to commit to. And there are different, I think this is what Emmanuel was alluding to. So under the Greenhouse Gas Protocol, it's fine to have estimates. And, you have an estimate, and if you're a big American corporate who's committed to net zero, it's really easy because you get rid of fossil fuels, you make it all electric, and you buy carbon credits. Simple, job done. And then you start saying to them, well, actually, your carbon credits are going to go up tenfold in the next 7 years. So what was $250,000 this year is going to be $2.5 million in 10 years' time. And what if that goes up tenfold again? Do you still want to start paying £25 million a year, $1 million a year, just to buy credits? Or should you actually reduce your carbon by making your buildings more energy efficient? And I think that's probably another thing to bring into this whole scenario. It's not just about carbon, it's about energy as well. So in all the net zero carbon building standards, including the one we're looking at in the UK, a building will have to achieve a certain energy efficiency level before it's allowed to buy renewables and call itself net zero carbon. So unless you are super energy efficient, in the UK, for instance, maybe have a neighbours rating or achieve the UK Green Building Council's 70 kilowatt hours per square per year, then you can't call yourself net zero as a building under those certification standards. But under the Greenhouse Gas Protocol and the Science-Based Targets, you could just buy credits for whatever you're using and call yourself net zero. So I think there is also a lot of different systems doing it in different ways. And the final thing I wanted to add for me is I only felt carbon would be taken seriously when it's actually being done by accountants. So every year I produce greenhouse gas footprints, I get them QA'd, I get audited, I've got all the data and all the kind of stuff. And that is done by myself as an engineer. And I said, when the accountants take this over, and S&P Global are just about to appoint their first person in the accounts team who's got responsibility for ESG. So they're going to apply the same rigor to this that they do their financial report and accounts, which is, I think, where everything's going to have to go. The more legislation around the place. So, an ever-evolving landscape, I think.
Sure. Emmanuel, did you add something to add, or?
Yes, maybe around your question about the I would say the strategy behind the carbon accounting. It's clearly, if you take the example of a construction company, I'm coming back to my first point around methodology, but if you want to assess or account your carbon at a corporate level to have the overall impact on your activities, and then you have different streams regarding action and savings. And for example, as a construction company, all the embedded carbon of the new construction and refurbishment will be in your scope 3. But it's clearly strategic that you have a work stream on these savings in terms of CO2 on scope 3, because a building with low carbon options or just performing LCA to all the new refurbishment and new construction building will be the basis of every strategy. So it is strategic for you as a construction company actually to take care of your scope 3 emissions. So of course, carbon accounting is purely strategic for those companies, and especially in the real estate industry.
Thanks, Emmanuel. I see there's a question from the audience, so I'll pick that up before we proceed with our questions. And Arti is asking, in terms of consistency, what do companies need to start doing now to achieve their carbon targets, and what are the regulatory bodies doing to ensure a consistent approach is adopted? And it's also asking, will the RICS play a part in this? I can quickly answer that. I think we are already. We just launched the second edition of the professional standard on whole life carbon assessment, and I invite the audience to go and have a look at that. It's greatly improved and expanded on the previous edition, which effectively became the unofficial UK methodology for building level assessment. And the new one has got more guidance, more details, distinction between project stages, distinction between infrastructure and building. So it is a great piece of work. But to answer the question is, what can company do now to achieve the carbon targets, and what are the regulatory bodies doing? If I can ask my panelists, maybe who wants to go first?
Yeah, I don't mind kicking off, as I work for a company with a lot of targets. Obviously, it's growing more and more. Everybody's setting net zero carbon targets. And as I say, most people think they're going to be all electric and buy credits and they'll achieve them, until we bring in what Emmanuel was talking about, is a net zero carbon standard for an actual building. So once a building has to perform in its own right, with its own targets to get to net zero, we move it to another level of importance and also potentially affecting costs. And so companies are looking at the moment of their global footprint, and then they're looking how they reduce their global footprint. as we go forward, landlords, property funds will be looking at their individual buildings and how they get each building to be certified as net zero. And certainly on the UK net zero carbon building standard, RICS are one of the bodies, along with CBRE and REBA, and everybody's coming together to help agree this standard. There's a steering group and then there's sector groups. And the idea is that this is something the industry will develop together and we will all use as a standard going forward. It'll have certification attached with it. And so companies, yes, are starting to do things, not quick enough and certainly not fast enough. And the main thing holding it up at the moment is regulation, because we have no legal definition of net zero carbon. We have no legal targets people have to meet. They're all voluntary. Science-based target initiatives voluntary. And so there is no targets and there's no penalties if certain targets aren't met. But I don't want to get too political about it. But I was just thinking that the regulatory bodies, a consistent approach is growing, and I say part of it. But the main thing stopping things going forward is always money. It's always costs. And I think, you know, some of the estimates are that the average UK existing office to get to net zero needs to spend on average £2,000 a square metre to get to net zero. It's all broad numbers, but of the buildings that were summarised and added together, there's a building in Cambridge where the Cambridge University has actually done a building refurbished to passive house, which I worked on when I was at ISG, and it's a great example of how you retrofit a building and actually achieve net zero. But it's not cheap, and they did it because they wanted to show how it's done. And you know, if you took that average cost of £2,000 a square metre for all the existing offices in the UK, I think when I was at ISG, we got somebody to do all the numbers for us, and you're looking at like 20 billion a year between now and 2050 in order to get all buildings to net zero. We're not spending anything like that on refurbishing our buildings. And the final thing to pick up on, that's for a whole host of reasons. Will tenants pay more rent? Because landlords only put money if the tenants pay rent, pay more rent for it. And will their buildings be valued more? And I'm not going to say any more about this as it's an RICS seminar, but for a very long time, people will know me, we have been talking about how you value buildings in terms of their environmental credentials and whether that will ever be reflected in property valuation. And I know the RICS is starting to think about it, but until a building loses, you know, capital value because it's not meeting standards, and until tenants will pay more rent or less rent for buildings that aren't net zero, where does all the money come from? You know, who pays for net zero is the main thing holding it up, even if companies want to start doing this. That's my take on it.
Yeah, I'd agree with you, Debbie. Mark or Emmanuel, do you want to comment on that?
Yeah, there's interesting statistics there, Debbie, on the cost of the buildings per square metre. It does.
I'm not saying where they came from, otherwise I'll name names. It was several states.
Yeah, no, I know. I'm actually sitting at the University of the West of England at the moment in their one of their estate buildings, and they're just finishing a 900-bed passive house scheme. So it's the big student accommodation. So it's the biggest, I think, in the UK in construction at the moment, which is a real achievement when it opens up. And I think, you know, you look at the benefits that they will get out of that building by, you know, operating it for the number of years. Yeah, there might be a little bit of a cost premium around the capital cost of constructing it, which is, I think, in some ways a little bit of the learning curve around the scale of the project as the passive house. But the benefits from the energy reduction and the carbon reduction are, you know, are huge. You know, you look at the over the life cycle of the building, the savings and the paybacks are massive. So there is no cost, there is no premium for achieving, you know, essentially a net zero building. And if you look at the demand, I think, from the students or the people coming in, you know, in their 17, 18, 19, whatever, they want to stay in something that is net zero. They don't want to stay in an old, archaic building that uses lots of gas. So, you know, it's drive the demand, I think, is there coming from particularly the younger generations, because they will vote or move based on the sustainability credentials of the university and where they stay. So I'm kind of selling the university a little bit here, but I think majority of universities and public sector bodies will have their net zero strategies, and I think it's really important that they do set those goals and those targets. And we as an industry has got a huge part to play in helping them achieve that.
Yeah, and I think new build, is easy. It's the easy thing. We've got to do new build net zero. It's just a fundamental. And yeah, similarly, I think when I was at ISG, we were seeing less than 10% increase in costs for all the savings over the life of the building. It's when you've got landlords with a lot of existing buildings, particularly the office sector, which will cost a lot of money to upgrade, but they won't necessarily get the returns on the rent. Who's paying that money? Is it tenants and landlords? Is it just landlords? Is it just tenants? Well, it can't just be tenants because it's got to be done to the fabric and everything. Yeah, lots of problems to solve, I think, going forward.
Yeah, that is a big question. Where's the money coming from? But Emmanuel, don't know if you want to.
One point, this is really an important question, but coming back to the question regarding the regulation, just a few words. I would say, of course, the regulation is growing, and the methodology, I would say, linked to the regulation is growing too. But then don't expect too much from the regulation. That's really important because, for example, on taxonomy or SFDR, which are today the main key driver for all the investors and asset managers, you will find scope 1, 2, and 3, but you will never find any definition of scope 1, 2, and 3. And I'm sure that won't be the case. So don't expect too much from the regulation. You can start now to collect your raw data, start with calculate with common methodology, and then I hope that some players like MRICS or others will help in deploying those standards, because the real estate players, all the industry, will benefit from a standard. And again, I'm not sure that the regulation can provide it, because for taxonomy, for example, there is so much activities that they can't be experts in any activities. And for example, in the real estate, you won't find any expert in real estate today in the commission. But then when I say a second advice, maybe is start collecting your raw data. Don't wait, because for example, we are, and then the CO2 calculation will be, I would say, something from the expert in back office. For example, with our customers, asset managers, for example, with GRESB, we are calculating CO2 emissions. For SFDR, maybe some other emission factors can be used. And for example, to monitor their net zero pathway using the CREM framework, we need another calculation because the CREM tool use some, I would say, other emission factors. That's not a problem. You have your raw data, you design and you perform your methodology depending on the framework, and maybe you will have your own objective. And maybe I hope that as soon as possible, there will be a common language in the real estate industry. But again, don't wait from the taxonomy to have specific standards and frameworks.
I'd agree with that. Since we're kind of moving actually on the topic of data, and that fits with a question that came from the audience from James, and that's he's saying calculating emissions from real estate almost always requires estimating where data is not available. For example, extrapolating existing data or using benchmarks. And he's asking, can we expect more prescriptive guidance on how this should be done? So it's, I guess, is if you don't have access to that raw data, if you do have access to that raw data, what do you do after that? How do you ensure that you make those calculations properly? I don't know if Emmanuel, you want to continue on that, or Mark or Debbie?
Yeah, maybe a quick one. Of course, if you have only estimation, that will be okay for your first assessment, but it will be difficult for you to have objectives and to monitor a net zero pathway, because you will only monitor the benchmark evolution. So, of course, this is a combination on starting to have real and raw data, and then to have, I would say, the full assessment, you need some estimation. And as much as possible, maybe one of the key KPI is the number of real data that you get regarding the total amount of CO2 emission. And you have to improve also this KPI. And improving it, it's typically something to involve all your stakeholders. your property managers, your tenants, so you have to involve all the stakeholders. Yes, there will be some challenges, but there will be, I would say, less and less challenges because all the real estate players need to move forward on this topic. So you need to have enough raw data to have your proper assessment and maybe to start to monitor a net zero pathway. Just to give an example, when we start working with an asset manager, we are working only with, I would say, top real estate players, but then when you start from zero, in 1 year, you can get more than 50 or 60% of real data. And then after improvements and stakeholders involvement, you can reach 70 to 80%. And the rest is okay. Because when you have like 3 tenants out of 5 where you have the raw data and the real data, then the model are really powerful to fill the gap, actually. So achieving a 70% of real data is something really comfortable to achieve and to monitor a net zero pathway. So don't be afraid of that and start.
Yeah, and I guess when we're talking about raw data, we're essentially saying, you know, energy consumption, energy bills, occupancy levels, information about the building size and dimension. That's the basic data that we're talking about that allows you to.
Yes.
Yeah, sure. Mark or Debbie, do you want to comment on that?
Yeah, I can always comment, but yeah, I think to begin with, people do include estimates. So S&P, I think, now have 93 buildings around the world, and we do have, I think, 15 of those where we have to include estimates because we don't have any sub-metering. And that's predominantly in the US, because the US leases historically have never insisted on sub-metering. So part of it is that, yes, you can use benchmarks, like Emmanuel said, but then you'll never show any improvement because you're always using the benchmark. Is that companies have to start getting their actual data. There's talk that the SEC in the US will have a minimum amount of estimation that you're allowed before you're fined. So you have to have your real data at the end of the day, and you have to find a way to measure it. You have to put meters in, you have to get the actual data and start collecting this actual data, as Emmanuel was saying. I think in the UK, you now, if you're a landlord building a multi-tenant building, you have to install sub-metering, but you don't in the US, not at all. You don't even have to bill using sub-meters. It's not even best practice in the US. So what we're doing in our leases is we've written our lease clauses, and all around the world, we're asking the landlord if they will put sub-meters in, and at a minimum, allow us as a tenant to install a sub-meter. Because some landlords say, no, you can't touch my risers, you can't turn off my, you know, data center and whatever. But I think it's down to whoever's trying to measure the carbon, the company, to look at how they're going to get all that data. Because benchmarks aren't going to work for very long. They're really not that useful, and it has to be measured somehow. Meters are quite cheap. We've got lots of technology. We've got lots of internet-based measurement and monitoring. You know, so yes, we've got to start going that way. And the main thing is we've got to know it's accurate. You know, the number of building management systems I've seen giving meter readings, nobody's ever checked them and calibrated them. Even brand new buildings where you look at the main meter coming in all the sub-meters and they don't add up. The sub-meters never add up to the main meter, and nobody ever checks it. And I did this, you know, just post handover, and had the electrical contractor saying, well, we don't know why that panel's using more energy than it's meant to. And I said, well, you're the electrical contractor, you've just finished the building, go and have a look, tell me what's going into it. And they're like, oh, all right then. So the lack of information we've got and the lack of metering, you know, is we'll have to change, and we'll have to start measuring this in a very strict accounting type way. Not just, oh, there's a sub-meter. Well, how old is it? When was it last calibrated? Have you got the certificate of calibration? Can you prove? Have you tested it? You know, have you put in temporary probes and tested that meter? Going forward.
Thanks, Debbie.
Mark, I saw you nodding vigorously.
Yeah, no, I agree. What Debbie was saying, you know, we've got to be able to sub-meter, got to be able to have that ability, and we've got to be pushing the landlords to retrofit if they're not there. You know, we talk about the green leases and so on, and how do we make sure we can get that data to help drive the improvements? Because yeah, the benchmarks aren't going to help. because they're not going to change or have any impact on it at all.
Thanks. So that was effectively all about operational energy and carbon, and we got another question from the audience, this time from Naresh, and they ask about the construction stage. Essentially, we're talking about embodied carbon. It's on the kind of other side of the coin, and they're asking the construction stage of carbon assessment depends on so many different variables: methodology of construction, the builder's approach, the timeline, type of construction. How can a carbon assessment be facilitated so that all the variables are factored to achieve the carbon emission in the construction and installation stage? So if I understand correctly the question, this is about, how do you manage all these variables, some of which are kind of unknown at the moment that you're doing the assessment, and how do you make that estimate essentially, or that forecast of what's going to be the upfront embodied carbon cost more accurate as possible, and how maybe you want to check that after the work completion. Don't know, Mark, if you want to enter.
Yeah, no, that's fine, thank you. Yeah, and it's an interesting one. I mean, I think I'd probably first start off by saying, well, we should be checking or forecasting the embodied carbon right before we get to the construction phase. So we're doing that as part of the design process from the beginning of the project. So we've gone through the sort of that curve, haven't we, of value managing the design for carbon and cost at the same time. And we've got a good understanding before we get to construction of what the embodied carbon assessment is. If you look at where the emissions actually sit within the embodied carbon, sort of the A1 to A5 module, the majority is in A1 to A3. It is in the actual material itself, the production, taking it out the ground, making it into something, the energy that's used to create the steel or the concrete. That's where the big bulk of it all is. And I think it's around the decision making on the material, how much material, the type of material has the biggest impact. Obviously, things around the methodology, how long it takes, the type of construction have a much smaller impact in the overall embodied carbon, because whether it's a tall building or a low building, it's the volume of concrete or steel that sort of drives the amount of embodied carbon within the building. So it's important to consider, but I think the big thing is actually looking at the principles of trying to drive out the carbon in the first place to make sure that the designs are as efficient as can be. So I think there are variables there, but the key one is the amount of material within the building, and obviously making sure you're using the right EPDs against the materials. And obviously things like the transport distances you can refine. You do get as best as you can do from the contractor. Hopefully know where the material is coming from in terms of where the travel distances are, so you can be a bit more specific. But again, they're not a huge sort of part of the overall embodied carbon assessment.
Thanks, Mark. Emmanuel or Debbie, would you like to add anything?
Yes, maybe a quick word on that. It's clearly, you're right, today operational phase is clearly more and more professional. And then it's maybe the start for embedded carbon, because it's clearly something that is coming after, even in the regulation, to be honest. But then it's clearly improving and growing today. At Deepki, for example, we acquired a company this year called Nuco, and this is a software dedicated to the carbon assessment of construction stage, which means that and there is a lot of innovation in this area. We are directly integrate some quotation from building engineers, for example, and then it's the calculation of the carbon assessment is automatic. First to perform an LCA analysis, because in a lot of new construction projects, it's compulsory to have an LCA analysis. But then it's a really powerful way to start and not, I would say, focusing on the calculation, but more on the expertise and the way to highlight some low carbon options. So it's clearly, you will see more and more software and innovation in this area. And this is today possible. Yes, it's complicated, but then it's because it's complicated that there will be a lot of innovation.
Thanks, Emmanuel. Debbie.
Yeah, I just want to add in there about, I don't know if the question was thinking about how you measure the carbon of the construction process as well. One thing that people often forget is how much energy has been used on site in the carbon construction, when it's a new building site, that's relatively easy because you can draw a boundary around it and think, right, we've had this much diesel, this is what the generators have been using. Eventually you might get a mains electricity supply and you'll have a meter on it because you'll have to pay the bill. It gets even more complicated when you're doing fit outs over the life of a building. And when I was working for Legal & General on landlord side, I could never get contractors to meter the energy within a multi-tenanted building and pay the bills. So the rest of the tenants end up paying the bill for the empty floor refit most of the time. So I think this is back to the point, you've got to be quite clear what you're including in your boundary. And another classic one that is refrigerant loss. You know, what refrigerant loss are you counting in your embodied carbon? I know one project that managed to leak a whole, chiller full of refrigerant due to an accident. Does that count into the building? And should that be offset by the purchaser if they want to count it net zero? And there's so many things like that, and the trouble is everybody's writing their own standards. So I know the RICS has got a tool for measuring embodied carbon that Will Arnold's been looking at for the net zero carbon building standard. A lot of people in the UK are using one-click LCA. I think Emmanuel just said they've got a tool, but they all do it slightly differently. So we can't compare apples with apples because they're all using different factors or estimating different factors. And as a civil engineer, the worst place for measuring embodied carbon is in the HVAC systems. We really do, because it's so complicated. You've got a screw from here and a valve from here and a bolt from there, and it's hugely complicated. And I know people are working on it, but there's got to be some kind of estimation still in that. And the final thing I wanted to say on that as well is we've got to be really careful, and this is my own personal view, of what carbon we're measuring. So when we're measuring operational carbon, it goes through a meter. The meter can be certified, calibrated, and we're pretty sure that's the energy use, and we turn it into carbon. Embodied carbon, as Emmanuel said, is still in its infancy. It's using so many assumptions, and having worked at a contractor, what is designed and signed off in a one-click LCA tool is not definitely what ends up on site. But who goes back and checks that every single bit of equipment that was put into that tool for the embodied carbon is what ended up on site? And especially, with COVID and supply chains, it's net. So is there a final completion checklist that checks that every bit of the model is now on site? There's got to be a lot more regulation to make embodied carbon as professionally accounted for as operational carbon. And you can't compare the two. So most people add the two together and call it whole life carbon. I think that's one of the worst things we can do. Yes, we need targets for both, but we can't add them up and compare them, because we lead to all sorts of wrong scenarios. Like a landlord says, I'm not doing this to reduce operational carbon because it's using more embodied carbon. So what are we going to do then? We'll just not have enough energy in the UK then? Everybody doesn't want to do that, So it's a complicated conversation, is what I'm trying to say. I'm not saying there are any answers, but and we could probably spend a lot of time on that one. So I'm going to be quiet now.
No, I agree. It's difficult, but I think as Fabrizio started off by saying, we've got the second version of the whole life carbon guide coming out from the RICS. Hopefully, the intention is obviously to standardise the methodology of at least how we measure and count and do the process. Obviously, the variable is anyone can pick whichever product out of one-click or whichever database for the same thing, which bit of concrete or which EPD we're picking, and that could come out with a different answer. But I think as long as we got consistency of the methodology of counting, and we're all trying to compare in the same way as best we can, I think that's a starting point, and it will mature as time goes on, and that methodology will improve. We've got our Turner and Townsend carbon calculator, it's based on our RICS methodology. And we're trying to integrate that with the cost management process, so at least clients can make the decision based around cost and carbon, both embodied and to your point, Debbie, about lumping in the operational carbon together, but that whole life carbon, scenario. So what's the best thing to do based on whole life cost and whole life carbon?
Thanks,
and I'm not saying, sorry, Emmanuel, I'm not saying there shouldn't be targets both. We definitely need an embodied carbon target and we need operational carbon targets. I just don't think you can trade one off for the other there. You've got to meet both of them. Sorry, Emmanuel.
No. Actually, I was to say exactly the same thing. It's just like today, I will be more comfortable with following two targets than just have a full target with everything inside. And just to let you know, I'm not sure that everyone is familiar with that, but in France, the new construction regulation is now including targets on embedded carbon. This is quite new and interesting because I think it's the first country that put that. It's I would say, the objective of the European regulation. But so let's say that the first threshold is quite I would say it's mostly an obligation of performing an LCA. But then the second one in 2025 will be, I will start to be hard, and then the third one will be harder. So it's a way to professionalize and harmonize the calculation, because now you have a threshold, which means that a new construction in France after 2022 must be below, I think it's around 1,000 kilo of CO2 per square meter, and then it will be 800 and then 500. So it's clearly a start when we need harmonization, because there is a framework and there is a threshold. And another really interesting point is like the number of product with an LCA is growing every year, and I would say every month. Just to have this information, we have a European database, because today it's more local, like country by country databases on LCA by product. But then the number of product with LCA was multiplied by 2 this year, which means that we have more and more accurate and validated data on the CO2 embedded in the product. It's a start, because I said that it was multiplied by 2, but maybe we are starting from very low number of products. But then it's just highlighting the fact that I would say year after year, there will be less and less estimation on this one.
Thanks, Emmanuel. If I could actually pick up on a couple of points. I think you're right, France is the first country they introduced as a separate target for embodied carbon. I believe the Netherlands have a combined target for operational and embodied carbon, which might be, as Debbie said, not really the correct approach. Maybe Finland also has some target, but it's really a handful of countries. In the UK, we have an industry-backed proposal for a Part Z in building regulations, which is essentially saying what Emmanuel was saying, let's start by mandating measurement according to the methodology, so we can build a good set of benchmark against which we can provide targets, which is already what is the net zero carbon building standard initiative is kind of doing, running in front of government. And on that, and it kind of leads to the last of our question, which is, once it's measured, how do you report it? How do you, communicate it that? And we are just about launching tomorrow as a consortium which is led by RCS and BCIS, the Built Environment Carbon Database, which is a UK-based platform for reporting the results of project-level carbon assessment. So it's not a calculation tool, but it's just a place for you to report and share that with essentially the rest of the industry. And it's also there's a separate section in that database that contains references to all EPDs. So we're effectively putting together what you were saying, Emmanuel, probably the European database, I guess you're saying EcoPortal. We're getting together other sources that we have one place where you can have an index of all the existing EPD and LCA of products. So if you're just interested, go and have a look on bcd.co.uk. I saw that there was a question from the audience, from James, which was about how do you think EPCs will change next year? I think there's kind of a side question on carbon accounting and a huge one. I guess a way to link that is, do we ever think that EPCs, which were born as a way to just inform the consumer and then moved on to as a way to enforce it and performance through the minimum energy requirement, at least in the UK, do we ever see those as being useful for carbon accounting, essentially carbon measurement in an accurate way, or we should just keep them the two separate? Debbie, I see you.
Yeah, I mean, EPCs are a theoretical model of construction carbon. You know, they were for a very specific purpose linked to the EU directive, and they are only useful when you are trying to give a future tenant the idea of how efficient the building was constructed to be. So they've got nothing to do with operation. So for instance, now when we're leasing buildings, I'm insisting and asking for the actual energy use intensities in operation. And we've just leased a building in Manchester where we found a net zero design building to 5.5 stars on neighbours. The other landlord wouldn't give us any energy data. When he heard that he was second in the list because of this, he suddenly came back and gave actual data through, rather than just saying, here's my EPC certificate. That said, I think they'll be around for a while because they serve a purpose that nothing else does when you're looking at trying to compare one building with another as an asset in a property fund. It's not about how the tenants are using the building or how it's being operated. If you want to buy and sell a building, you want to know how well it's constructed. But they will certainly be superseded by models which predict operational carbon and all the CBRE codes on that. And they will become much more important along the lines of neighbours and the neighbours ratings predictions as well. And the other point about EPCs is I think, you know, there was talk of not being able to lease a building that's a C rating or above. I'm pretty sure I heard the other day that's been completely dropped for residential. For commercial, there's just nothing said about it. It's been held up in committee for about 5 years, at least that I know of. Whether it'll ever come out of there, people can make their own, you know, sort of guesses about and who might bring it out and why. But I think EPC will stay just as it is for quite a while because it does serve a purpose.
Yeah, we can say that you know, a BRE-led technical group is developing the new SAP assessment for the underlying methodology for the EPC. So there will be an update and hopefully an improvement of that methodology to make them a little bit more reliable than what they are at the moment. I don't know, we just have very few minutes left. I don't know if Mark or Emmanuel, you want to comment quickly on that?
Yeah, I think we need a full webinar on EPC. Not one. So maybe let's keep that for another discussion.
I think
Sure.
so, yeah.
Okay, great, thanks. Then I'm afraid then time is running out. I really want to thank our panelists, Debbie, Mark, and Emmanuel for being with us here today, and Deepki as well for help with the organization. Also want to remind the audience that we'll publish a recording and a written summary of this webinar online. So do please feel free to share those with your professional networks. Also, please take a few moments to let us know about what you thought of today's sessions. You can do that by completing the online poll, which will appear on your screen at the end of the webinar. And you can also have a look at our list of future webinars and conferences, as you can see on the slides here. And remember also the recording of previous webinars are available online. You can also check out our podcast series and have a listen and let us know what you think. And finally, you can follow us on X, Instagram, and LinkedIn when you can receive news of upcoming webinars and catch up on anything that you might have missed. But thanks again to our panelists. And then until next time, goodbye, and I hope you have a nice day.